and gentlemen, good afternoon, good evening, good morning, depends on what time zone you're on, I guess. This is Sean Ragland coming to you from Atlanta, Georgia. I'm excited to spend the next about hour or so with you as we begin this process and program called the Tax and Retirement Strategies Seminar. But again, I'm honored and excited to visit with you today. If you are joining us and this is the first time being introduced to our firm, again, thank you for being here. Again, few disclaimers real quick. I want to make sure you're clear on what we're about to cover. The information contained in this presentation does not constitute any investment advice, and nor is it an offer to sell or a solicitation to buy any securities or any insurance product. It's information. The entire presentation does not guarantee any rate of return on any particular investment, and nothing in this presentation should be construed as rendering tax, legal, investment, or accounting advice. It's information at this point. This presentation is designed for educational purposes only, and information contained in this presentation is time sensitive and may need to be adjusted due to the changes in securities, insurance, and or tax laws or the times we live in. And most importantly, just be clear, what we're going to cover is high-level conversations, and just know you will not learn everything in an hour to become wealthy. Although we're going to give you enough information to start to chew on and hopefully get some more further information moving forward. You know, with these times that we're in, and again, I just want to give you a little bit of a history. Again, I got in this business in 1996 because I watched my family and my parents get devastated in the 80s because my parents' advisors had ripped them off so badly that my mother and father, who did fairly well, my dad ran a big hospital, had advisors working for them, but they were sold the wrong products. They were misled. Most people are neglected or overlooked, but I watched them go through the things that I'm showing you on the screen right now. They faced very challenging times from a place where they were comfortable and secure, so they thought, but then all of a sudden they found themselves in very dire times where they lost their house, they started fighting over money, they ended up losing their marriage. In fact, I walked in at 13 years old as my mom took a knife and cut her hands and took a handful of pills to end her life. She attempted suicide because they lost everything financially so quickly. And that was within an 18-month period of time because of the lack of knowledge and the lack of information. And that's why we do what we do, to make sure that on the road to financial security, on the road to financial independence and stability, people are not overlooked. They're not misled or they're not neglected. I mean, let's just talk about today and just look around the news. If you look at the media right now, you know, again, I got to ask yourselves the question, are you having a hard time with your current bills? I mean, we just got out of an incredible, what we call a bull market, where the stock market is doing great. And we seem to have got out of the recession from 2008. But now there's some challenges going on because of maybe this COVID-19, this coronavirus, or other things that are going on in the market. Are you drowning in credit card debt? Again, foreclosure was a big conversation many years ago, but who knows, that might be coming back in the future as people maybe lose their jobs. Are you prepared for an emergency or a challenge? Are you properly insured in case something happens to you? God forbid you get this virus and it takes your life. Are you properly set up? Are your children, your family, your wife, your husband, is the livelihood that you want to leave behind, is it protected? Are you concerned for your children's education if something were to happen to you? Or are you concerned with your children's education to begin with? Are you set up for education expenses as they get through these times and make it to retirement, or in this case, college? Are you losing money on your investments? I mean, this last week, if you have a 401k retirement account, which we're going to talk about, I hate to tell you, be the bearer of bad news. You probably already know this, but you probably lost some money, and it might be even a considerable amount of money. And that could have been protected. We're going to share with you some ideas on that. Are you worried about your retirement? Are you worried when you turn on the news, you turn on Facebook, you turn on the media, there's nothing but negative news? And if that's the case, I want to give you some hope and let you realize that there's an opportunity where you can maybe do something different. You can't turn on the news without hearing a bunch of negative conversations. Retirement doom and gloom. You got the coronavirus crashing out millions and trillions of dollars, just negative after negative, just conversations after conversations. But by the way, negative news is not new news. The negative news, if you're listening to CNN, the constant negative news network, or you watch Time magazines, you go back to the 70s, it's always about negativity. Negative news sells papers. Negative news gets people's attention, unfortunately, in this society, especially today. And if there's anything about this coronavirus that I believe, in my opinion, is true, is that the media is causing massive hysteria and panic. I'm just here to tell you in just my own conversation, take it for what it's for what it means. I'm just here to tell you that if we're talking about the stock market in particular, that is in all-time lows in a sense of the markets have corrected over the last couple of months. No, last couple of weeks. Just remember, if you go back over a century, 100 years, the short-term outlook might look dire, it might look scary, but the stock market of America has always rebounded. In fact, if you believe in America like I believe in America, which I believe all of you should, then you just need to take a deep breath and realize it's going to be okay. Long term, it's going to be okay. In fact, I want you to take a quick second and go back to 2008 in your mind, the last time we've had a correction or a recession. Would you have done things differently in 2008, 9, and 10? By the way, most people in America that are billionaires right now, they took advantage of 2008. And I'm going to show you some ideas of how you could take advantage of the negative downturns if you understand. I mean, at the end of the day, the ultra wealthy right now, they're protecting themselves, but they're taking advantage of the moment. Wealthy people get wealthier during times like this with the right advice and the right vehicles. And the reason why we're doing this right now is to help you learn how to get the right vehicles in place, or at least learn or teach you where to get it. At the end of the day, you don't have to know exactly how all these things work. In fact, my great mentor, a gentleman named Greg Cap, says, you don't have to know all the information. You got to know what you know. You got to know who knows what you don't know. And that's all you need to know. And I'm here to tell you that is a true statement, to say the least. But let's take a look at this. Let's go back to some ideas. I'm going to give you 9 blind spots. I'm going to touch on these very briefly, just so you can take some notes. And if you're recording this, great. We will make this available for others. And again, if you put your email and send me an email, I will be giving you some guidance and some tools and some gifts on this presentation. But again, 9 blind spots that you need to be aware of if you want to become financially successful. And it's a lot more than just the coronavirus. It's right now than the decrease of the market. Number 1, you need to, regardless of the markets are good or bad, you got to have some goals. Most people have no goals. In the words of Stephen Covey, you need to begin with the end in mind and put a plan together, not just in your mind, but you need to put a written plan together so you can take all things in consideration and hit those goals. Many people go out by themselves and they have no guidance, no professional guidance, that is. Some people have their rich uncle or their person that's a plumber that has a big opinion, and they actually guide themselves from them. I'm recommending you get a professional advice. I mean, if you get the coronavirus, I hope that you don't just go on to WebMD and try to self-medicate yourself. Go to a professional doctor to make sure you're taken care of. Well, same thing when it comes to the finances. You probably want to go to a professional that understands and has some knowledge and a working conversation and experience on how to get you through these times. By the way, most people spend way too much. They have no budget and they're just a spender. And I admit I'm kind of a spender too, so I can understand the conversation. But these times it's about saving and protecting your money. Number 4, and we're going to talk about majority of today, we're going to talk about taxes. And most people in America, because they don't know any better, are underestimating their taxes. And that's what we had Jinder open up a little bit with some conversations. But in regards to, again, identity theft, which could affect your taxes, in regards to, again, April 15th coming in when you need to file, and in regards to all the things that are happening, we're going to talk about taxes a lot today, because taxes are your number 1 enemy, I would agree or argue, when it comes to your finances. What about the other thing, though? You got to get a good rate of return, because most people don't realize inflation, even though recently inflation has been quite low, inflation at some point in time will catch up. And you can look on the screen to look back in the 70s and 80s and the cost of certain things, whether it be a glass of milk or stamps or eggs. At the end of the day, in the next 20 to 30 years, inflation will catch up at some point. So if you're not getting an after-tax rate of return on your savings and investments that's outpacing inflation, folks, you are going negative. You're losing money. And in these times where there's fear, I will tell you a lot of people are doing that. I'm going to show that to you in a quick second. A lot of people save too little. Again, they're not savers. They're spending more money. And you say, and I hear this all the time, but Sean, I have more month than I have paycheck. I don't make enough money. Well, that's another consideration. Maybe it's because your bills are not aligned and you don't have a proper budget. That's one of the things that, again, I encourage you to do is get with a professional like us where we can help you save some money by what you're already spending. We'll get into that at another point in time, not today. Number 7, most people retire too soon. By the way, there is over 100 million baby boomers that are hitting 65 years old today or will within the next 18 months or 18 years. And some people hit the button too soon and they're not properly set. They thought it was just an age. They thought if I just make it to 65, I could retire. It has nothing to do with your age. It has to do with the pile of money you have and how much you can take out of it. And again, we're going to give you some examples of that today. Number 8, a lot of people are dependent upon Social Security, and Social Security, the government's going to take care of us. And you know what? We're going to have programs where everything's going to be free. I'm just here to say that's not what wealth people rely upon. You need to rely upon yourself. And we're going to talk about Social Security here in a quick minute. But most importantly, and worst of them all, is procrastination. Most people in America, they think they're okay, we're all right, until things like this happen, like the coronavirus, and the market's correct and they hear it in the news, and now all of a sudden they want to do something about it. Well, that's fine. It's never too late to start. But procrastination, the cost of waiting is millions of dollars to you potentially, if not hundreds of thousands of dollars. Again, do not wait to get your life in order. If anything positive comes out of this coronavirus conversation, number 1, it's going to teach us all to wash our damn hands and have good, proper hygiene. But also, we're going to get people off the fence of actually starting to save for their future and start to learn how to become independent. And again, we want to encourage you to do so. Now, that all being the case, let's talk about let's summarize what I just showed you in a picture form. I like pictures. I'm a simple guy. When I saw this for the first time, when I saw this conversation for the first time, honestly, it scared me because, again, it was all conversations and legalese. So I will use pictures today to help you understand. If you're like me and most of this goes over your head, don't worry, follow the pictures. The pictures are going to help you along the way. Bottom line, when it comes to wealth, and if we were in an audience, I would ask the question, how many like to become wealthy? Raise your hand. And God willing, all of you would raise your hand. By the way, if you don't want to become wealthy, I don't know why you're on this presentation. Go watch The Bachelor or something. But if you want to become wealthy, stay tuned, because we're going to teach you how to become wealthy. And the reality is, it's real simple, by the way. Again, money plus time plus rate of return, subtract the inflation cost, subtract your taxes equals wealth. People say, well, I got money. Well, it doesn't matter how much money you have in a bucket. It matters what you can spend and use. And too many people fall into that game. So again, enemies of your money. Number 1, risk. Risk right now is a major concern because, again, if you watch the markets, it's crazy. It's up and down, as I showed in the first couple slides. Man, the markets are dropping 2,000, 3,000 points over times, 10, 20% from last week to this week. Risk is a consideration if you have no downside risk protection. And I'm telling you, wealthy people, they learn how to manage their risk. It can be controlled. Number 2, again, I already talked about it, inflation. You have to get a good rate of return. And if you're so scared of the market and you run to your local Wells Fargo account or your Bank of America account or your Chase account, let me just tell you, you're just making the banks richer, I should say. You got to get a good rate of return because inflation will come back at some point. But taxes, once again, the rest of the conversation today is mostly going to be on taxes. If you do not find the proper tax shelters in play, I'm just saying, as a 20-year veteran in this industry, considered to be somewhat of an expert, speaking all over the world on these matters, you need to get your taxes in line. Because again, we'll talk about that more in a quick second, but it will come and haunt you if you don't. Number 2, or the last one, time. Once again, procrastination, start early, but also get yourself disciplined. Build wealth requires discipline. And if you're not wealthy, it's probably because you just made poor decisions and you weren't disciplined in your matters. And hopefully we're going to change that today. So let's go back in time for a quick second. There used to be what we called 3 pillars of economic security. If you go back to the 100 million baby boomers in our country, this is what was talked about all the time. Again, if you had a pension at work and you had some savings a little bit on the side, and you had this wonderful thing called Social Security, you're going to have the retirement lives of the golden years. You're going to be able to work hard and then play hard later on. The golden years was going to start at 65 years old. The funny thing about it is when Social Security started, the average life expectancy was 72. So you had about 7 years in retirement to enjoy all this money that was supposedly saved up for yourself. It is the largest source of income for most elderly Americans today, which is scary. But again, it was never designed to be the only source of income. In fact, let's look at pensions. Pensions used to be a what we call the defined benefit plan. Means you work for a company and the company will define a benefit for your life because you're only going to live about 7-8 years when you're retired. Well, that got replaced in the 80s with a thing called the 401k. Many of you probably know what that is or heard of it before. 401k is section 401k of the Internal Revenue Code. And we're going to talk a lot about that today and what that section of the IRS code means, because there's a lot of myth conceptions about it. Personal savings, yeah, that's like a pogo stick in America. It goes up and it goes down because the next iPhone X75 comes out and you just got to get the next one. And if you're an Android lover, then it's the other thing, whatever it is. Well, again, phones that are now costing $1,000 a pop, when people don't have $1,000 to spend, most of the time they take it out of their personal savings and they wonder why they never get ahead. And Social Security, really, that should be more like social insecurity. And we're going to talk about that a little bit later today. So those three legs on that stool is kind of challenged. Now, by the way, if you have a stool like that, and if you ever sat on one, it's okay. It'll sit up properly if all those legs are taken care of. Like I'm on a stool right now, it doesn't have 3 legs, but if one of those legs falls or breaks, man, you could fall. Well, I'm here to tell you some of those legs are broken in most people's lives, and we want to make sure we can protect you from that. So let's take a look at this real quick. First of all, some of you know who this guy is. He's a good friend of mine. Warren Buffett is a great, great friend of mine, at least by the way of a book. Man, I wish I had an audience. Maybe you would laugh. I'm not sure. Some of you already heard that before. Whatever. I think it's kind of funny. Anyways, I think he's a good friend of mine because I read all of his books. You know, it's great when people put things into context, their experiences, and a godfather of investment, this guy, Warren Buffett, he puts a lot of information out there for people to use. The question is, are you listening to it? Are you reading it? Well, if you aren't, let me help you understand what he talks about. One of the rules of Warren Buffett is this. There's 2 rules of money, folks. Number 1 is to not lose any money. That's his number 1 rule of money. One of the most richest men in America, self-made. He made his money in the markets, et cetera, billions and billions of dollars. He says the number 1 rule of money is not to lose any money. The number 2 rule is don't forget number 1. Now, by the way, are you in a place that are losing money? Now, there's options for your money. Let me just very simplify it to a point where, again, fixed accounts are like your saved accounts, your bank accounts, your CDs, your money markets, accounts that give you a fixed rate of return that someone will guarantee. Insurance companies will give you a fixed rate of return if you put money with an insurance company. But the fixed rate of return means it takes out your risk, but what it does, it gives you a very low rate of return, so low that most people can't live on. In fact, Wells Fargo today, I just checked it right now, the Wells Fargo most popular savings account right now is 0.01%. That's right, 0.01%. By the way, some of you know this formula. Albert Einstein says if you take an interest rate and divide it into the number 72, that will equal the number of years it will take money to double. So if you have a 0.01% because you're afraid of the markets and you hear the news, and the stock market, which is the variable market, the mutual fund market, which is the variable market, where returns are being able to go up and down, average over about 12% or so over the last 80 years. I won't go that in a second. You're afraid of that because of the news, but you want to stay in your fixed account at Wells Fargo. 0.01 divided by 72 is 7,200 years. That's right. It takes you 7,200 years for $1 to turn into $2. I don't know about you, but I don't have 7,200 years to wait. I know I look good for my young age, but 7,200 years, I'm going to be dust. I'm going to be dead. And I don't want to wait for Wells Fargo to guarantee my 0.01%. I need to get a little bit better interest rate because inflation, if I'm making 1% even, and we're subtracting inflation at 2 or 3%, and I got to pay taxes, you get the math from the wealth formula earlier. Now, again, variable markets, stock market, mutual fund markets, ETFs, all these different types of accounts in the variable side, that is where growth is. That's where the rich play. But what if we could do what, again, Warren Buffett explains, where you can put some stop losses on. You can put some guarantees on your money. I don't know about you, but that right side, that indexed account, again, if you can have the ups of the market, but when the market corrects like it did last week, you don't have to worry about it. You see, all week I've been fielding calls, hundreds of calls. Again, I have thousands of clients all over the country, and this week has been one of my busiest weeks ever. And I've been so thankful that, again, I got involved in a company that teach wealth concepts to help my clients that had money in the markets, that had money in 401ks and retirement accounts and stuff. We had these things called indexes on it where it didn't lose a dime last week. And I took countless clients online and I showed them their accounts, and man, their excitement, their enthusiasm was so great, and their gratitude and their gratefulness was so high that if they could see me, they gave me a hug. In fact, some people that were here personally did give me hugs. I had grown men and women crying because they felt the sense of relief that they were protected when everyone else around them were saying that they weren't. Again, I don't know, would you like to have that protected income where, again, you don't have to worry ever again about the market, but you can still capture the higher rate of returns? Those are things that we're going to talk about at another seminar. That's not today. By the way, put this in your calendar. I will go into very specific terms. We are, for next month, the financial literacy month of the country. April, yes, is the financial literacy month of America. It was declared many years ago by law. And in honor of that, on April 15th, yes, tax day, Wednesday, April 15th at 7 p.m. I will have a link to this, and as we close out today, we will go into greater detail on how to protect your money and how to grow your money and rates of returns like that. Today is not about that. I just want to plug that into that conversation. Today is more about taxes. Now, by the way, if you're not protecting your money, that's a major concern. Once again, sign up for our next program, which will be on April 15th. We'll get into how to maximize the returns, and we'll get into how to, again, optimize those growth and protect yourself. But again, more so than even the growth of the rate of return challenge, the ups and downs of the market, the risk of the market, which again, I can't say enough, is a major concern. The bigger concern today that we're going to spend the rest of the entire time on is on taxation. I mean, again, I love this picture, and ask yourselves if this is true. Again, you think taxes are ever going to go away in America? No, of course it's not. That's a dumb question. But think about this real quick. What kind of taxes do we pay? How much do we get taxed? It's more than most people consider. When you make money, they tax it, right? If you're on a W-2, you get this thing called FICA taken and withdrawn from each one of your paychecks. By the way, have you ever wondered what FICA stands for? Yes, that's right. It's funds I can't access. Okay, I thought that was funny. Anyways, gosh, it's so hard doing this without an audience. I'm laughing at myself. I do it quite often. But bottom line, when you make money, they tax it. It's called income tax. Yep, you know what? When you spend money, they tax it again. It's called sales tax. In fact, in certain businesses, if you own things that you bought, like a desk that I'm sitting on, or again, this computer screen, there's a tax for you to use the property that you own. It's a whole nother tax. It's called an excise tax for business owners. When you save money, if you don't do it properly, you know what? There's a thing called capital gains tax. They tax it again. In fact, even when you die, they tax it again. It's called the estate tax. In fact, I'm dealing with that as we speak. My father died, unfortunately, last year, March 24th, and I'm dealing with probate and estate taxes as we speak. In fact, I have to file his last remaining tax return, even though he's 6 feet under the ground. Crazy to consider that. The reality of it is taxes are a major consideration. And if you're not paying attention, you're going to tax away your entire life. But you know what? Rich people do things a little bit differently. So let's talk about tax planning and wealth planning for a quick second. And I'm going to make this super simple for you. There's 4 phases when it comes to savings. And if we take a look at, for example, what we call a tax as earned investment, there's only really 3 or 4 different kinds, just to put it out there. It's kind of simple. But understand this, when you put money into something, that's the contribution phase. When you're saving and contributing to your account, if you're in a mutual fund, if you're in a saved account, if you're in stocks, if you have a portfolio, a diversified portfolio, hopefully, as it earns money every single year, you got a 1099 recently, and you got to pay taxes on the accumulation. But again, when you put money in, sometimes it's an after-tax contribution. There's no benefit when you put money into it. Whereas I'm going to show you in a second, there are accounts that you've probably been lured into by your accountant, by your CPA, by someone at work, called the 401k and retirement account, where you get a tax deduction upon contribution. As it accumulates, does it grow tax deferred? We'll talk about that more in a second. When you pull money out, the distribution phase, do you have to pay taxes or not? And when you die, and by the way, I hate to be the bearer of bad news, but none of us are getting out of here alive. It's a bad joke right now. But again, we're all going to die at some point. And when we do die, Does the money and assets and money that you have saved, does it go to someone that you care for, like your family, your wife, your husband, your children, or your church, or whomever you want it to go to, or does it go to Uncle Sam, your favorite uncle? Again, most people, when it comes to mutual fund stocks and CDs and all those kinds of accounts, they're tax coming and going. Then years ago, back in the early 80s, a program came out called an annuity, and some people don't like annuities. Susie Orman, Dave Ramsey, and others will tell you how bad annuities are. But I'll tell you what an annuity does in the traditional form and fashion. Annuity is like a pension. It's all it is. There are different kinds. Some are good and some, I would agree, are bad. But an annuity from a tax perspective gives you one green circle. And by the way, if you don't remember anything, remember this. If you want tax benefits, you want more green circles, meaning you want some tax favored treatment to it. In fact, I'm going to show you what that looks like in just a quick second and prove to you that just having tax deferral alone is a substantially greater impact to your future than you can possibly imagine for some of you. But by the way, if you had two green circles, and again, this is where people are getting lured into getting those individual retirement annuities, which is what they originally called, or individual retirement accounts nowadays with other types of investments. Or they were created because they created Section 401k of the Internal Revenue Code. That 401k allows you to have a tax deductible contribution and allows you to have tax deferral on top of all those other benefits of being able to deduct it from your current income. And it sounds good, and I'm going to show you the math. But again, two green circles, I would admit, are way better than one to some degree. But let me ask you a question. How many like to have four green circles? How many like to have your money tax deferred, tax favored, where you pull the money out and take all the money, and when you die, it goes to your family tax free just the same? I don't know. Four green circles are way better than two, and it sure is heck better than one or none. But let's not to go off into deep end. I'm just give you some math here for a quick second. I'm going to show you something that some of you have never seen before, and you can do your own calculations. Let's take it back to simplicity's sake. Let's say you had $1, right? $1, and you're going to double it 20 times. In this case, we're going to start with 18, and then I'm going to show you what the 20th time would be. That could be 20 years, it could be 20 times, it could be whatever. If you get a really good return, your money could double quicker and faster. If you would get a really bad rate of return, it's going to double slower. So let's just keep the time frame out. Let's just say double 20 times. Again, that thing says 18 years, but it might not be 18 years. It could be 18 months if you get a good rate of return. Bottom line, as you can see, if you take $1, double it 20 times, but then pay taxes on it every single year that you earn the money, what happens is after 18 years, you're going to have $12,000, $558.24. Yep, that's how much you will have in this example. Now, if you took the exact same dollar and double it 20 times, it's like a snowball. Money that money makes more money as it grows and compounds over time. As it grows and grows and grows, more money that's kept in the account actually starts to compound and double. And you could do your own math. 1 turns to 2, and 2 turns to 4, and 4 turns to 8, and you get the point. If you took the exact same 18 doubles instead of $12,000 because you had to pay taxes all along the way, that's right, folks. You have over $250,000. Now, again, I wish I could see you by show of hands and loud screams and cheers and or whatever. How many would rather have $250,000 for the same doubling effect of $1 or 12,000? Yeah, hello. When I saw that for the first time, I didn't understand it, but man, that meant to me 1 green circle was a hell of a lot better than none. But by the way, let's take this out one more conversation. You know what? If you did this 20 times or 20 years, look at the difference, folks. Again, you took this out 20 years or 20 times. You had $1 double 20 times in a taxable investment. You're your stock portfolio. You're a day trader. I don't know, whatever. Fine. You're having to pay taxes every year. And if you doubled your money 20 times, you'll have $26,000. Congratulations. But if you can just get tax deferral, you'll have over $1 million there for you to spend and use how you so desire. Once again, $1 million or 26,000. One more time, in case you lost me. $1 million that you can spend to do whatever the heck you want if it's situated right, or 26,000. Yeah, I think I hear you. I hear you. I can't hear you, but I think I hear you. I can hear your sound waves. I think you probably have the $1 million. So how do you get the $1 million? How do you get tax deferral? Those are things called qualified plans. Again, your IRA, your 401k, do you know why they call it a benefit? Because when you put money in, you're able to not only get this tax deferred growth, that one green circle, but you're also able to deduct what you put into it. And it sounds so good right now. I get it. You don't want to pay taxes right now this year on Uncle Sam. You hate April 15th coming up. It's the worst day in the country unless it's your birthday, but it's Uncle Sam's birthday. And I hate it personally. I hate paying taxes. At least I hate paying my unfair share. I like paying taxes. I love our country. I appreciate paying taxes. I know I have to do my fair share, but if I can by legally means deduct or have pay less, I think we'd choose that. But let's talk about, again, how things work. Again, you need to be aware of this. And again, how many of you have an IRA? How many have a 401k? How many of you know someone that has an IRA or 401k? I bet all of you do. So make sure you understand the pros, but it would be wrong for us to not also explain the cons. You see, here's the challenge that most people aren't completely aware of. I hear people over the last 20 plus years tell me, I got a 401k, when I pull the money out, I don't have to pay taxes on it because I'm retired. Wrong. You have to pay 100% tax at whatever income bracket you're at that point in time. The seed that you've never paid taxes on, and all of the harvest is taxable at ordinary income rates, which is higher than capital gains rates. I won't go into that right now, but that's a challenge. Also, another thing, you have to pull it all out over a certain period of time, and you're going to see this in a second. Otherwise, you're penalized massively. There's an early withdrawal penalty that most people are aware of, we'll talk about, but most people do not know there's a late withdrawal penalty of a very high number that most people have never heard of. We're going to make sure you're aware of it in case you have one of these suckers. But also, by the way, whatever's in the account, when you pass, your family, your heirs might have to pay taxes twice. In fact, there was a news article in Time Magazine. There was another one in Newsweek. I used to carry it with me, but for sake of time, that says if you had an overstuffed IRA or 401k, meaning you had too much money into it, which I don't even know what that's like. What do you mean? What is too much money anyways? But inside of a 401k, there is an account where you can have too much money. If you have a too much stuffed portfolio or account in a 401k or an IRA, your heirs can get as little as 10 to 15 cents of the last dollar you saved. Again, it's a crazy conversation to consider, and we want to make sure you're protected or at least aware of it. Now, that being the case, let's take a look at the math. I'm going to show you some math, simple math. Again, most of this goes over my head, but when they show me these numbers in simplified terms, a dork like me that failed economics twice in college before I came to this firm and started learning the financial education in practical terms with tools and pictures and things, they had to show me the math very slowly. And again, this was a scary topic for me. And again, if I go here and you find yourself checking out, just stay with me. I'm going to make this simple. I promise. I'm going to show you pictures. But for you smart people, we got a lot of very smart people. We've got some people that have, they got PhDs and bachelors and MBAs and all these different degrees, and they're engineers and they're super smart. And I appreciate that. I'm not necessarily like you per se, but I'll tell you what, you'll like this next couple slides because we're going to get into the weeds and the details of it. Here's a simple idea. Let's say you put money in your 401k. Let's say you put in $250 a month in this example. Well, $250 a month times 12 months is $3,000 a year. It used to be the old limit that you could put into an individual retirement account. It has now been increased, and I'll explain those limits in a second. Now, let's say you're in a marginal tax bracket, which marginal tax bracket is your state taxes and your federal taxes. Your benefit for contribution, that first green circle in those pictures I showed you before, is that whatever you would have had to pay on your income is deducted from your total adjusted gross income, and you get to put that back in your pocket, either in the form of a refund or less tax payment at the end of the year come April 15th. And here's how the math would work. If you put in $3,000 a year into your 401k or your IRA, and you're at a 30% marginal tax bracket, just to round it up, that's right, you get $900 a year in benefits that either you get back in a refund if you've overpaid, which is a bad thing to do, and you get a refund, meaning you give the government a loan all year with 0% interest at the end. Not that smart if you think of it that way. Or you pay less than $900 at the end of the year, which is what you're owed. Well, if you did that over a 30-year working lifetime, that's $27,000 of benefits your account, your CPA, your following the crowd got you to enjoy. Now, by the way, if you took $250 a month at 12% interest for 30 years, and I'm going to use the interest rate of 12% for hypothetical purposes, although on April 15th, we will show you how to safely receive between 9 to 15% interest on a guaranteed basis. Not guaranteed, in an average basis, excuse my language. Bottom line, we'll use 12% because if I go back over the last 100 years, we've actually averaged 12% with all the ups and downs of the market. So just entertain me for that, because we're going to assume the best in this case. By the way, if you did the math, $250 a month for 30 years at 12% in a tax deferred account, let me just tell you what the number would be. It would be $882,000. If it were taxable, it'd be about 430 some thousand. Real quick, can I round up 900,000 or 400,000? I'll give you a second. I think 900 sounds better compared to 400. That's that tax deferral thing. If you're doing a monthly contribution, that's the math. Okay, that's the good news. And oh, by the way, some of you say, yeah, but I get matching. My company matches me still. God bless you. Most companies don't. And if you got matching, fantastic. Double the money. So instead of 250 going in, it's 500. And if 250 goes in at 12% for 30 years, you'll have 900. If 500 goes in, you'll have just 1.78 million, something like that. So I'm going to round up to 1.8 million to keep the math easy. Okay. But you engineers, I know you're having a heart attack about that one. Just stay with me. I'm rounding up. Okay. I went from 882 to 900 and 1.78 to about 1.8. Just in case you are engineers there. I know we got some engineers on the screen. I got you. Now, by the way, let's take some money out. We're going to pull out 10%. We're going to draw off of our income. We're making 12, and the idea, according to Robert Kiyosaki, is to live off your interest. That's the idea of being wealthy. Have a passive residual income, and if you can get your account earning 12, we're pulling out 10. Now, I'm using 10 as just a hypothetical, simple math. But if you pulled out 10% of your $900,000 nest egg, congratulations, that's $90,000 of income. Yep, that's the math. But oh, by the way, now 100% of all the money you put into it and all of the 12% interest is now taxable every year at your tax rate that is currently whatever it is. Now, let's just assume it was the same 30% as it was today, marginal tax bracket. Well, 3 times 9 is 27,000. That's right. That's $27,000 that year you have to pay in taxes. That just wiped out 30 years of tax savings. Let me say that again. Let me go slower for some of you. Your first year in retirement, assuming you got this interest rate, assuming you did this for 30 years, wipes out 30 years of your benefit. Your CPA should have told you that, but they don't think about today. Your accountant should have told you that, but they're not worried about today. They're worried about today. We're worried about the future. And we'll go back into the future here in a quick second. Oh, by the way, those of you that hopefully, God willing, you retire at 60, 65 years old, whatever, you're going to live at least 20 years. Well, if you add it all up, you gave back $500,000 to what? Save $900 a year? I'd be willing to give back the $500,000 or keep the $100,000 or $500,000 and give back the $900,000 or $27,000 over your lifetime. Sounds like a better deal. Oh, by the way, those of you that are still stuck on matching, listen, most of the time, if you do the math, sometimes matching never even goes to you because it increases your tax bracket across the board. We know you're going to be paying even more because if you're at $180,000 of income, forget about Social Security, forget about anything else. You're rich, but just know you're going to be paying more in taxes. And all of that matching is going to be going to Uncle Sam because you're going to have to pay more in taxes. So again, $72,000 of income tax that year is going to the government. That's assuming you pull it out during the window of opportunity that Section 401k creates. That's right. If you take money out because you have enough money now, you've done well, you are a prudent saver like my father and mother, and they tried to retire early so he could coach my football and my wrestling. My dad was a coach in the '72 Olympics. I was a wrestler. He wanted to coach me instead of some other Yahoo. But when he tried to retire with his SEP IRA, because he was lured into these same kinds of vehicles that are called 401k SEP IRA type accounts, he was penalized so much they lost everything. Yeah, it's a 10% penalty plus state taxes plus federal taxes. And for him, it bumped him up to the next tax bracket and they lost everything with 18 months because of taxes. So I get so passionate about this and why when I hear people say, oh, put your money in a 401k, it's the best thing ever. That's what I hear. I'm like, wait a minute, do you know all of the other facts? And if you have one, don't let me get you depressed because, oh, by the way, if you did it right, you made it to the finish line. Make no mistake, there's another rule called the 70.5 rule. By the way, it's now 72, but RMD, and write that down, RMD. In fact, I was in an audience say, pull out your smartphone and just Google, ask Uncle Google.
Wi-Fi network. You can reconnect to Wi-Fi from your Google Home app under devices.
Sorry, Google sometimes is annoying. I got to kill her for a second. But back to the point, go back to Google, ask Uncle Google what RMD penalty is. That's right, type RMD penalty and hit enter, and you're going to see that the penalty starts at 50%. By the way, it's called required minimum distributions. You must pull your money out and pay your increase in taxes. Otherwise, not only do you have to pay your taxes, but you're going to pay an additional 50% plus your state taxes, plus your federal taxes. Yeah, that's going to be a high one. I can tell you in 20 some years, many times people have never heard of that and they get freaked out. Do you have a 401k? Did you know that? And if you didn't know that, maybe you should pay attention and figure out other alternatives to that. You see, again, just over time, man, if you have to pay the taxes on your income, I don't know, what if there was a way to have all that money and not give back that money to Uncle Sam? And the question becomes, is there an alternative? And the answer is absolutely yes. And there has been one for years and decades, in fact. In fact, when I share with you these concepts, some of you are going to get upset. And by the way, don't get mad at the messenger. So here we go. RMD. Once again, not going to get into that in greater detail. Just make sure if you have one, you got to start planning for taking the money out in the proper time. Otherwise, you're going to have a 50% penalty plus your state and federal taxes. Not a cool thing. Let's switch gears on this conversation. Now, again, I'm going to spend, a few minutes, and I'm going to get into this going a little bit faster because I want to be able to spend some time, but I'm going to go probably about 15, 20 more minutes, just so you know, just to give you some time horizon, because I know it's 12 o'clock, and we want to try to keep this to an hour because I know many of you, in a webinar setting, some of you are already distracted. You're probably out playing Fortnite or something. I'm not sure. But hopefully, if I can get your attention, I'm going to save you hundreds of thousands of dollars, and maybe you could keep your attention for another 20 minutes or so. So bottom line, here's the question. Is postponing taxes really the best idea? I think of it again like this little apple up there. You got this nice apple, and I hear this all the time. Yeah, I got a 401k, Sean. I got my retirement account, Sean. I got it in my company's 401k. I got an IRA. I'm good. Susie Orman said. That's fine, but after you pay your taxes, it's like having that little worm eating your entire nest egg. You might have some challenges. Again, here's the fact, and I'm going to show you some math. Your IRA, your pension account, your 401k will be taxed at retirement probably at a higher tax rate than you are now. In fact, did you know, listen up, did you know that having a 401k type account could cause you to pay taxes up to 85% of Social Security that you may have? I'm not sure. Did you know that having 401k type account could cause you to pay taxes up to 85% of your Social Security benefits at retirement? Let me say that again. Did you know that if you have a 401k, you're probably setting yourself up to where you're going to have to pay a tax of 85% on your already taxable account that was called Social Security? It's a slap in the face. Most people never heard of it. When I heard of this, I was like, are you kidding me? So let me just ask you, if there were a way where you can draw out your retirement income and reduce the 85% of your Social Security that yours owed to you, and you could pull it out tax-free, would you be interested? Again, would you be interested in an alternative plan that can eliminate all unnecessary tax legally, of course, that has been in law for decades and decades, that have been time tested by millionaires and billionaires alike? The problem is most people don't know about it because they're not billionaires. They were reserved for the wealthy, and we're going to share that with you today. But first, let me make sure, and again, this is just not me saying. Again, take a screenshot real quick if you can. These are some of the things I'm going to send to you. If you will email me, again, Sean@raglingroups.com. I will be sure to send you some things, some links, some papers to give you a gift, because I know this is going fast. But if you take a screenshot and go to that website, it's the IRS website. They would tell you that the tax code is setting people up where there's certain thresholds, and I wish I could make that bigger, but for time's sake, I'm just going to skip it. It does exactly what I described, where if you have certain thresholds that you hit between all of your income sources and your retirement accounts that you had set up in the past, you're going to pay up to 85 to 50% on your Social Security. This is not hypothetical, folks. It's law. Again, I wish I had more time to get into that. I'll send that to you, but let me just keep it simple. Think of it as buckets. You got your taxable income when you retire. And I'm specifically talking about those that are going to be retired at some point, which I hope it's all of you. Now, by the way, if you're within 10 to 15 years of retirement, listen up. By the way, if you're 20 and 30 years old, listen up. It's going to affect you if you make the wrong choices. Bottom line, if you have stocks, mutual funds, bonds, income from any sources, rental income, whatever interest earned, that's called taxable income. Then if you have any of the things I mentioned, 401ks, 403bs, 457s, IRAs, SARSEPs, simple IRAs, pension accounts, profit sharing, defined benefits, those are tax deferred accounts. When you add those two together, then what you're going to have to do, you're going to have to add up 50% of whatever Social Security benefit you actually get. When you add all those three components up, it creates what's called a provisional income. I wish I could see you, but how many of you ever heard of provisional income? Until I got in this business years ago, I didn't know what's a provisional income. I have no idea. Well, what it is what most people aren't aware of. And again, Susie Orman and Dave Ramsey and others aren't talking about. It's that, again, if you have a single person, if all those things calculate to over $25,000 of income, $2,000 a month, you're going to have to pay 50% tax on your Social Security that you've already been taxed to get it. By the way, if you're over $34,000 a year of all sources, that's less than $3,000 a month. You're now having to pay 85% tax on your Social Security benefit. That's right. Married couples, you can see the math. I have people that are retiring and they're like, wait a minute, why am I paying more in taxes? I'm retired. It's because of this. People were not told about their 401k, about their IRAs, that were going to cause an additional tax on top of their tax. I don't know about you, but that pisses me off. Excuse my language. It makes me mad. I'm sorry. I got to be nice and Christian-like. The reality of it is, what if there's an alternative? And the question and the conversation is, there is. What's the single greatest contributor to your Social Security tax? It's having too much money in your 401k. It's having too much money in your IRA. It's doing what you were told all these years to put money in your 401k because everyone was doing it. The problem is, it's going to cause you some major tax issues. So let's talk about some alternatives. Now, by the way, that's assuming you're going to have Social Security. And just a real quick plug for those of you that are younger. If you're under 45 years old, turn it up. It's kind of like the song. Again, this is actually my 401k statement, or my Social Security statement. This was a couple years ago. Again, in 2016, my statement said very clearly on the first page, you used to get these in copies, that again, without any changes, by 2037, the Social Security Trust Fund will be completely exhausted. By the way, in 2016, a couple years ago, 4 years ago, we began paying more in benefits than we collect in taxes. If you spend more than you make, what happens? The damn thing gets tired? No, it gets broke. Now, real quick, I'm not going to go into this because I don't have the time, but if you have a 401k with an old company, I would tell you that I normally like to make blanket statements, but don't leave your money with an old company. There's lots of reasons for it. We just don't have the time to get into it. You do want to move your old 401k into an IRA so we can protect it and give you some benefits. If you leave it where it was before, you just lost money last week. And there could be a way where you don't have to lose money with your existing account. Let me say this again. If you have an old 401k with some old company that you're no longer working with, don't leave it there. It's an option, but it's not a smart option. And we don't have time to get into the details. If you want to know more, give me a call afterwards or send me an email and we'll connect. Just for sake of time's sake, don't leave it there. Let's spend the last 15 minutes or 5 minutes, actually 10 minutes maybe, and show you the alternative. How about that? Now, you know what? I'm over time. I'm sorry. It's 12:08. I'm 8 minutes over. I apologize. I wish I could have got to it all. So, you know, some people are very time conscious, and I am too, by the way. I was raised by a Navy SEAL. But you know what? We're just going to have to probably postpone this to the next meeting. I'm just kidding. I'm going to give you what these tax-free retirement accounts are. I mean, let me ask you a question. If I showed you a way where you could save hundreds of thousands of dollars in legal structures where instead of being in an IRA or 401k, your taxes, ordinary income on all the money you're going to be paying more. And I'm going to show you a mathematical computation and example of it. Would it be worthy of another 10 minutes to kind of bear with me? And I think the answer probably is yes. In fact, I just got a bunch of text messages. I'm going to cover it. Just relax. Having fun with you. Have a drink later because you're a little bit more uptight. Maybe you need a Corona for the Corona. Anyways, all right, stop it, Sean. I'm having fun. I hope you are too. If you're not having fun at work or at home, then stay home. I don't know. Let me tell you what they are. How we like to have, instead of having taxes at ordinary income rates at whatever income rate you will fall under and up to 85% on your benefits, what if you could have zero federal taxes for qualified distributions? Once again, let's call it 20 to 85% or zero. I think I would choose zero. Again, for your engineer type, let's break down some math. I'm going to show you a couple different examples of what could be your kinds of situations. Let's just say, hypothetically speaking, you had an 8% growth rate. You had a 50% federal tax rate during your contribution phases. You were at a lower tax rate during contribution because you weren't making all the money yet. But then when you retire, again, because the tax rates in America had gone up over time, and we'll go back there in a second, it's now 25%. And by the way, your Fed tax rate, sometimes you can't control. In fact, I'm going to show you in a quick second, in the next few years, you won't be able to control whether it goes up or not, regardless of where you're at. And again, let's assume there's no minimum required distributions taken into effect. Well, let's say you put money into the account for 25 years in this example. You had a 401k and you put in the exact same amount of money, exact same period of time, all the way up to the 25-year mark. In a 401k, you put in $11,000, and a Roth 401k and a Roth IRA, which we're going to tell you what it is, and a CVLI or a LERP or a 7702 plan. These are other names of what I'm about to show you. You put in less money because you had to account for the taxes that you had to get up front. And when I say taxes, meaning this, in the 401k, it's a pre-tax contribution. You took your tax deductible account and maybe kept it in there. The other one, you didn't get the tax deduction, so we're going to account for it to the tune of $1,700 per contribution in this example. Now, when you get to retirement, you got $926,000 sitting in your 401k. And opponents to the Roth 401ks and Roth IRAs and the CVLIs and the 7702 plans and all these other things we're going to talk about, there will be less money in your balance because you have less money going in. Hello, we're talking about the same interest rates. But listen to me. It's not how much money is in the account. It's how much you get to spend after taxes. When you pull the money out and then pay your taxes at 25%, one, you're going to pull out $70,000. The other one, you're going to pull out $80,000. And again, if you take it to the next few years, I don't know, $1.4 million of distributions or $1.6 million in distributions. Which would you rather have? And if there's even additional benefits, would you just like to have more money? And I think the argument is yes. I don't know. So now all of a sudden, having these after-tax contributions might make some sense. Let me show you furthermore. But before I go there, I got to propose the question. Do you really think in America, regardless of who's elected, who cares, that our future tax rates over the next 20 to 30 years is going to be lower, the same, or maybe higher? Yep, I hope you said higher. If you have any sense of sensibility, it's going to be higher. Well, again, let's talk about it. You see, if you defer taxes, you're going to increase your taxes at a later period of time. Again, you will have to pay more in taxes if you defer your taxes, folks. Let me prove that to you for a quick second. Now, again, don't trust me. I'm some dork from California that's a surfer. I used to have long, nice black hair, and man, I won't even go there. So don't trust me. I'm going bald and I'm gray, and yeah. So go to this website. It's the government website. Yeah, that's right. The Congressional Budget Office. Take a screenshot. I will send this to you later if you can't take the screenshot. But are you prepared with the fact that if you were to read it all, it basically says by 2026, that's right, 6 years from now, our tax rates expire. And for the most part, all of our tax rates will go up about 3% off the top. I don't know, 3%. Not 3%. That's not that much. Yeah, it's a lot of money, folks. If you make money, understand it's going to go up. By the way, let's just go back in time though. Once again, take that screenshot, taxpolicycenter.org. Don't trust me, go online. If it's online, it's got to be true, right? But this is tax policy. This is, again, code. It's law. It's not me saying. We're just bringing it to your attention. If you were to go back and look at the marginal tax brackets of America, folks, we're at some of the lowest tax rates we've seen in years. Listen, you go back into the 70s and 80s, we were at an 80, 90% tax rate. When we were in war, 92%. Can we get back to 92%? Don't know. But let me ask you something. Again, bottom line, let's recap. Ask yourselves the question as we get into the solution. Do you really believe your future tax rate will be the same or higher? If the same, then hey, continue to build up your tax deferral bucket and take your pre-tax distributions and pre-tax deductions now. But if you think it's going to be higher, I'm going to highly recommend that you pay the discounted tax rate now and enjoy a future tax-free retirement income later. Most experts actually believe that our future tax rates are going to be as high as 90% again. Why? Well, the deficit, Medicare depletion, Social Security shortage, the coronavirus, this, that, or another. We may be at another 90% tax bracket. Would you like to shield yourself for any of those things that we can't control? And the answer hopefully is yes. So let me share with you for the next few minutes just what the options are. And again, I'm not going to get into greater detail. I'm just going to give you an example of it. Because if you want to know more, we probably should get together so we can explain it to you. We can explain it to you in greater detail so you can get a grasp on it because you probably never heard of them. First of all, you have pre-tax or after-tax, couple chances. If you do an after-tax contribution, when you pull the money out, it's tax-free. It's that simple. Again, growth phase, get taxable yearly or have it tax deferred. No, I'd rather have the tax deferral and the tax-free upon distribution. The seed and the harvest becomes a much better thing if you can not pay taxes on the seed and the harvest. That's the game, is what we're trying to accomplish here. Again, that's just a picture. Your checking account, your saved account, CD, stock portfolio, your mutual funds, it's taxed now. If you put money, all of those in a 401k, 403b, 457, IRA, SEP IRA, annuities, pensions, Social Security now, those accounts will be taxed later. Even investment property, if you follow or break certain rules, you may have to pay taxes on gains. But Roth IRAs and 529 plans, which is designed for college funds, and things called the 7702 plan, a CVLI, and LERP, these are all different names of roughly the same thing, gives you the benefit of, yes, tax-free distributions and potentially can avoid that 85% tax on your Social Security. So let's explore those for a quick second. First of all, the Roth IRAs, love them. By the way, they're awesome, but you'll see here, this is directly from the tax law. There's certain limitations of Roth IRAs and Roth 401ks that you may not be eligible for. If you actually been successful in America, you make over $196,000, $124,000 as a single person, which means you're successful in America, you're not eligible to participate in this kind of a program because they think you're too successful. You're too wealthy. You've done too well. You work too hard, so you shouldn't participate in something as beneficial as a tax-free wealth building system. It's kind of crazy. By the way, even if, let's say you're over 50 years old and you want to catch up because you want to retire, you're limited to how much you can put into these buckets, and think of it as a bucket. What if I were to tell you again, there's an alternative where there is no income discrimination? You can put as much money as you effectively want to. I have clients that put in $100,000 a year into these programs, and they are now tax deferred and tax free. There's no penalty upon accessing the cash value of 15.5. Wish my parents had these kinds of things. There's no tax or market risk whatsoever. In fact, you can even fund your own health care or long-term care needs with the account. It's an added benefit on top of it, and the benefit is what shelters it from taxes and loss. But if you have some type of health challenge, you can have that accomplished as well. Wow, what a concept. It's kind of like a Swiss Army knife, isn't it? I mean, you see, think of it as a bucket. Again, not going to get into greater detail, but we used buckets earlier. This is what we're talking about, folks. Internal Revenue Code 7702, subsection A, provides for a benefit of a program that you can put money into the account. It grows tax deferred. There are certain structuring and layers that have to be taken into consideration. And you must purchase an insurance contract with a cost of insurance that pulls out of it, which, by the way, if you were to do the math, is usually about 1 to 3%. But if you purchase the insurance account, and by the way, I hate insurance companies. Let me say it for the record. I hate insurance companies, but if I can use insurance companies to my benefit and learn how to manage it and pay 1 to 3% for a insured account that's not going to lose any money and it's going to be completely free of taxation. Here's the question. Would you pay me 3% if you don't have to pay 50 to 75 to 85%? I think the answer is yes. And those are the two options. You pay 2 to 3% to protect yourself, but then you never have to pay taxes. So what have otherwise gone to taxes? Why not have this insured account? Now, there's additional benefits that you need to be aware of. And I wish I had more time to go into it, but let me just say it this way. This code allows you to structure an investment grade insurance contract, and you can use this as a tax favored, non-qualified private retirement planning alternative. Man, that just made me sound smart, or at least that sounds smart to me in the mirror. The reality is, let me explain what that means in English, simply put. But let me also let you know, this is not just me talking. Many financial leaders over the last 20 years have been talking about this in all kinds of books, but they've been focusing on the wealthy. Multiple streams of income, and that page talks about a VUL, which is the different version of it, is one of the most powerful investment vehicles ever seen. It's having all the advantages of the best retirement plans and none of the limitations. The financial pocket knife, again, IUL, the one we're going to talk about that has additional benefits, is one of the most powerful financial tools ever designed to help families build a strong financial foundation. I might suggest you get some of these books. Once again, that's going to be the gift. If you send me an email, I'm going to send you an anthology of books that you can get on Amazon or wherever at the Barnes & Noble, and you can start reading up on some of these concepts because you need to be aware of it. By the way, MarketWatch, yeah, they're called tax shelters. You can have tax-deferred growth and tax-free access. There isn't any other package that's been around. This is back in the 2000s. So again, it's not new. But we're not talking about insurance like your parents have, folks. We're talking about an evolution where you use insurance for your benefit, not just for dying. And again, let me explain the insurance. Insurance is a death benefit insurance. If you die, your family gets whatever's left over plus all the cash. But oh, by the way, if you don't die, you get all your money back. You get all your money back and then some, 100% tax-free. Just let me give you the summary of it because we're actually out of time, and I want to show you two more things before we wrap up. Bottom line, what if you could take money, put it in a pocket, and think of it as a pocket knife? Again, pocket knife are very useful. You can use it for all different kinds of means and needs and desires. Now, by the way, the policy has insurance that, yes, provides you protection against if you die, if you get injured, if you get hurt, if you get sick. Yeah, let me say it again. If you get injured, hurt, or sick, the money that's in your account can be used to provide protection against all those needs. But by the way, everything above and beyond the cost of insurance, which could be boiled down to 1 to 3% cost, which you're probably already spending in some type of insurance account already, you just combine the two and attach them with the vehicle. It's called a hybrid. What happens is all of the interest in your investments grow. And again, it's grown with investment returns. You can tie it to the markets. You have downside risk protection where the last week or to 2 weeks, none of the clients that have these lost any money. They were protected. They were insured. There was a crash. They were protected because they were insured. Most people say it's expensive. I don't want to pay for the insurance expense. Well, how was that 30 to 40% loss this last couple of weeks? By the way, by the time it's all said and done, it might be 30 to 40%. Last week was already at 20% loss. Would you rather pay 20% or would you rather pay 2 to 3% and have it grow tax deferred and tax free and all the other benefits of liquidity and tax advantages? And it's free from credits or lawsuits or any other type of negative connotation. 3% worst case to 1%, which is really the general cost, or 20, 30, 40% in loss, 20, 30, 40% in market corrections, 20, 30% in taxation. I don't know. Again, when we get into greater detail, it kind of makes all the sense in the world. Well, as I wrap up today, I'm just going to show you one example and then we'll call it quits. Let's go back over time for a quick second. And I just want to compare because I know some of you are so stuck on, but Susie Orman said, and my accountant said, and my attorney said, and I read on the news and I read on the paper, and my neighbor has one and my uncle has one too. But I have a 401k, a 403b, an IRA, a SEP IRA, and you know what? I'm going to stay true to that because that's what everyone else is doing. I've never heard of this before, you say. I understand. I get it. Trust me. But let's just compare apples to an apple. Let's go back to 1998 to 2014, and we're going to use, assuming you use the 401k or any one of your investment vehicles in the S&P 500 to keep it simple. By the way, which is what some accounts are trying to mirror and model, I should say. You go to 98, 99. Again, I got in this business in 1996, so I remember these days of 20 plus returns. And then all of a sudden Y2K happened. No, March of 2000 happened and the dot-com bubble bursted and markets went into a tailspin. And then we had 9/11. And for the first time since the Great Depression in America, we had a 3-year period of time where the accounts went negative. So if you started with $100,000 in this example in your account, you went from 100 to 128 to 155, and then all of a sudden the market's corrected to 141, and oh, wait a minute, you're down to 124, and hell, you're down past what you started with. And people panicked and they got out of the market. So the truth is, most people, when their account went negative, they actually sold and went to their banks, and they're not even getting the 28% jump that the market came back with, or the next year of the 10% or the 4 at 15. We didn't see that run on the market until, 2008. But then in 2008, the market dipped and went down. But then again, right after 2008, notice after all of the negative downturns, people that go to the banks because they're scared, they miss the best runs on the market like right now. That's a whole nother topic. Come back on the 15th of April. We're going to talk about how to max out the returns. And by then I will be willing to bet you, hopefully the markets would have rebounded if we're not into a pandemic that lasts extensive periods of time. And if it does, it's great opportunities, because when the markets do bounce back, and they always will, look at the returns that were made in that case. Man, you would have ended up with $203,000. You would have doubled your money by 2014. Now, by the way, if you went to an IUL, here's the good and the bad. The IUL in this case, we're going to use Transamerica, and the Transamerica caps have what's called a cap. You don't get all 20%. You're capped out at 15%. But when the markets went to zero in 2000 and 2001, 2, and 8, I want you to notice something in the other account there. Their account was at 0.75%, because that's a guaranteed floor of 0.75%, but a high of over close to 15%. In fact, there are some accounts that have unlimited caps, but we won't talk about them. We'll just use an average one, 15 to 0.75%. That's right. Your 100,000 went to 115. This looked better. This one's now at 132. This one looked better. But man, when this one dropped down to 141, this one still doesn't look as good because it's a more steady return, but you didn't lose any money. You're still making a little bit. By the way, when this account went back to 97,000, you would have loved to have an IUL because you were at 135. By the way, when this came back 28%, 28% of 97 was still only 124. You're still ahead and ahead and ahead and ahead. Oh, wait, when this one dropped again, almost 60,000. Yeah, you're not worried about that. Your account's still steadying along like a silent Eddie, like, the train that could. And when it was all said and done, because the money is stacked upon each other, and as Warren Buffett said, it's more important to protect the downturn than necessarily have the best returns, you would have actually double the amount of money. Double, folks. But more importantly, over here, you now have to pay taxes on 200 grand. Over here, you got double the money and it's tax-free. I don't know, which would you rather have? $200,000 and pay taxes, or almost $500,000 tax-free? Folks, when you see the numbers and them actually go back in history over time, it's irrefutable. And so again, I like to end by challenge you to consider this as I wrap up. What if all your life you thought something to be true turned out not to be true? See, again, what if all your life you listened to people that didn't necessarily know? I'm not faulting CPAs. I'm not faulting accountants or even most financial planners out there. Most of the time, they just don't know what they don't know. The reality of it is, some people just don't know the truth. If all your life you went through your life, you found out something to be true, would you not want to change some things up? Would you not want to take a look at maybe looking at alternatives? At the end of the day, it's about alternatives, of finding out the options that are specific to you. Now, by the way, let me make this clear. Each one of you has your own situations. By the way, an IUL for some is not the best vehicle, just to be clear. A VUL is not the right vehicle for some and not right for everybody. 401ks is not the right vehicle for everyone, for everybody. It may be a good fit and solution for a time. Each person is different. Just like when you go to the doctor, God forbid you get sick, you may or may not have an illness or a disease or a virus. You may have something very specific to you. Don't get caught up in the hype. Let's get very specific to you. That's extremely important. You got to have the right fit that fits you and your circumstances. But sometimes it's just how you see things. You know, for the lack of vision, people perish. It says it in Proverbs 29:18. Not to quote to you and not to preach at you. Come back tomorrow and I will preach at you. But the fact of the matter is most people have no vision of what could be. And they get caught up in the negative and the mayhem. They get caught up in, well, I've never heard this before, and they can't even hear or see the forest through the trees. We just want to encourage you to consider there might be some other options. And I'll end with a couple funny slides. You know, again, a beaver looks at a piece of wood as breakfast. Man, it's going to make me full. It's going to be nice to eat. Again, a caveman looks at the exact same stick and says, man, I can cut that down and I'm going to use it for firewood. The purpose is different, but it'll have some benefit. And that would be a funny video or picture of Archimedes, who would look at that stick and turn it on a lever and use it to move and leverage things and move the world maybe. Same stick, just how's it seen? How's it used? I mentioned insurance as an investment vehicle. We use different examples of things to look at things differently. It's just in perspective. Unfortunately, though, most people have their head in the sands. You, the taxpayer, you're following what everyone else is doing because that's what everyone else is doing. And sometimes following the crowd, like today, why we're not together, we're not with the crowd today because, man, you might have a damn virus and I don't want to see you in front of my face because you might infect me. But maybe your head's in the sand because you listen to everybody else and you're not even open to possibilities. And Uncle Sam's waiting for you. I'm just suggesting there's alternatives that I know your accountant said to do it. Your accountant right now says, no, we got to max out your IRA right now up to April 15th because you're going to pay taxes today. I think hopefully we made it in a conversation that your accountant or your attorney or advisor, maybe even, there might be some monkeys sitting on the shelf going, I don't even know what a fulcrum really is. I don't even know what I should do. Maybe I don't know what I don't know. And I'm not saying we have all the answers. We don't. But we have a team of advisors for the last going on over collectively hundreds of years. It represents hundreds of companies. And we sit down with an individual. We can sometimes do some things that, or at least think outside the box, that can maybe make an impact for you. If you'd never had a financial session, whether it's with a CFP like me or one of our advisors, I want to encourage you to get back with the person, whoever invited you to this seminar. And again, I want to thank you for the time that you spend with us, a full hour and a half, which I wasn't intending to go through that, but hopefully you got some value and some benefit. What I would encourage you to do, and I'm going to send you a gift, this next picture, which I'm going to show you, which is a form. If you're interested, I might suggest that you get with, whether it's with us or someone, to get a proper financial education. Get with someone to make sure that you can have your proper documents taken care of and looked at and reviewed. If you don't have an advisor, get one. Whether it's with us or someone else, I don't really care. Just get with a professional that can analyze and help you navigate yourself through the myriad of different choices that it takes to become financial independent and successful in America. Your financial independence is your right. It's part of being an American. But most people don't have the education, don't have the necessary steps. And whatever you do, do not procrastinate. This is not a time to sit back and say, everything's okay, it's going to be all right. This is a time to be proactive. And maybe because we have to spend time, again, being quarantined or in an office or in a room, we can do video chats all over the country at any time of the day. We don't have hours. We serve our clients when their needs need to be served. So again, this financial survey, if you will please send me your email, sean@raglingroups.com. That's spelled S-E-A-N period, S-E-A-N at RAGLANDGROUPS.com. I will send you the survey that you can get back and fill out for your own sake. And then I encourage you to get back with the person who invited you out to the office to see how we can serve you. And I close with this. There is something that is more powerful than all the armies in the world. And that's an idea whose time has come. Victor Hugo said that. And I wanted to reiterate the fact that your time to become financially independent and get through these times is your right. And you will get through these times if you have the right information. And just know, stay positive, stay excited, stay focused on your future. And this time that we live in is a challenging time, but challenging times just makes people stronger and better in the end. And with that, folks, thanks for joining us. Come back once again on April 15th, and there's the information. If you want to go on to eventbrite.com, it's already up and ready. You can register for that event. You can, again, come to the next seminar. We will spend all of the time talking about how to maximize your returns and how to take your investments to the next level. We won't focus on tax that time because by that time, April 15th, we will celebrate on that we just finished Uncle Sam's birthday, and we're going to focus on our future. So with that set in mind, folks, have a wonderful night. Take care. God bless. Be safe out there. Bye-bye.